me on my, thank you, Federica, into our first new workshop. So this is one of our first events. It won't be the last. And we have so much that we can cover in 2 hours, but we are limited, of course, of the time and of course the type of bespoke information that I can provide on the workshop. So I have prepared a couple of slides. I'm not going to read them all in detail. They're there in the background for you guys to follow and to sort of give a little bit of sense of what I'm saying. And then, of course, you can read them in the background. But that's the idea, is to give you an overview of what's investing and what is important to invest. Some of you, most of you, as you were logging into the workshop, had the opportunity to ask questions. So I have taken some of those questions and highlight them in the presentation, so then you can see what I've done with the question and how I was trying to answer it. But I would just want some disclaimer on the answers, because I don't know who you are. I don't know your personal situation. I don't know how much information and knowledge you have. Therefore, this is assuming that you have a little bit of level medium-sized information of investment. I've been trying to answer the questions as probably as easy as I can, but my suggestion in here, if I have not answered the question, or if you still have any issues on the answers, I suggest you use the chat box in the Zoom tool. I'm assuming that you all know how to use it. So you have a little sort of a chat box. So then, not to interrupt me, just keep yourself in mute and then just send a question, and then I will eventually be able to answer those questions on a one-to-one. Okay, so I think now we got a couple of people at, on the shop. So I'm not going to be looking at so much at the camera. Just give me this thumbs up if you can see the screen. The presentation.
Yeah, and if you can see Carolina, because I got a message that somebody was not seeing her. Your camera.
Okay. The thing is, the more and more people will join in, you will lose the ability to see your faces. Therefore, it will keep moving around. But don't worry about my face. Worry about the presentation. Okay, so the first thing I want to do is to give you a little bit of a background of myself. Some of you know me, some of you don't know me. And then, of course, I want to introduce Federica, which is some of you know her, some of you don't. So my background is always been mostly on financial services and management consulting. I have been working as a management consultant for the last 20 years. So have I come across with quite a lot of situations whereby I have to work organizations, look at the plans, the P&Ls, and look at ways of reducing costs and increase the profits. Therefore, I've always, probably the last 25 years of my life, I've been involved with finance one way or another. So I have seen the implementation of investment from a corporate level, but also from a personal level. I'm passionate about money, and the reason I'm passionate about money is because I understood for a very small age that money gave me independence, gave me freedom, and gave me the sense of achievement. And it's not to be materialistic. This is not about buying expensive handbags or, buying the Ferrari. It really is the sense of being able to make decisions and do things that you want to do without having to ask permission, right? And one of the things that the lessons learned, I think I was when I was 15, was that I worked really hard for years, and I think some of you can relate to this, making handbags and sort of like little sort of purses in leather, and I used to sell them, and I have a couple of people in this workshop who used to buy them. So and I accumulated quite a nice bunch of money. And then I used to say, put all that money into my drawer in my bedroom, until one day I decided to say, okay, I'm just going to put all this cash. I'm going to put it into the bank account. And instead of actually going personally to the bank account, I gave that cash to one of my mother's assistants who used to work for her. And on the way to the bank, she got robbed. And all my money was gone. And I remember that my biggest lessons learned is, if you want to keep your money, you manage your money. I should have gone to the bank. I should have taken the responsibility, deposited, and take a little bit more attention on it. And I hope this lesson really, not just my lesson, gives you a little bit of the objective of what I'm trying to push in here is, doesn't matter how much money you got. The key here is to be able to understand your money. Don't be scared of your money and be able to manage it. It's your responsibility. Nobody else is going to do it for you. So that's one of the things I wanted to sort of bypass as an introduction. And this is why I'm so passionate of this new venture that I actually started with Federica. And if it wasn't for her, I would not be here. I'm passionate and she knows me quite well. And I think she saw something that I could share with the world and some people who will be interested to actually maybe learn from my experience and learn from what I know and give them the confidence that they need to actually path their own financial freedom. So I'll pass over to Federica so she can have the time to introduce herself.
Hi, everybody. Thank you for being here. And we're happy to host this little workshop. We actually received very interesting questions from you. Well, to give you a brief background of myself, I've been in the music industry for 12 years, and there was a moment where I earned a lot of money, but I didn't receive a financial education in my life. And when I was earning these big amounts of money, and I didn't manage it, and I now regret it because it came to a point that I was needing more money that I was making. So I've known Carolina because of my mom. She's one of my mom's oldest friends, and I actually grew up with her. And I've known her experience with money, so I gave her a call one day, and I asked her. I actually expressed myself about my situation with money, and one call led to another and led to this beautiful venture that we've been working on to offer to people. Because since I didn't grow with financial education, we've seen that it's a common problem between a lot of people around my age and even older people. So I'm 31 years old, and people around me that are starting to make bigger amounts of money are now looking for options on how to invest, but it can be very overwhelming because there's so many information out there. And we put together this project, Plant Ahead, implying to invest ahead of time so your money can grow, and to provide education and Carolina's coaching experience with her passionate approach with money. So we hope this is very useful for you. And Carolina has tailored beautiful information for all to you to enjoy. So let's get started, Caro.
Thank you. Okay, so as I said before, if you have any questions, just don't raise your hand, just add it into the comments, and I will aim to leave a couple of probably maybe 15 minutes at the end and try to answer them verbally. So for the next slide that I have in here is what is this investment? So I'm not going to read it, but I got a couple of things that I want you to take out of this information. It is of course, as you say, is grabbing some money, right, and put it on the side and then trying to make it grow. So I think about it like you have a tree, or you have something that you believe on, even your children. You invest time. You invest time, dedication, care to actually make something grow. You do that with your children. You do that with your plants in the garden. You do that with your personal preferences, your hobbies. So money should not be any different. Investing, you need to is putting the time that it requires to actually start to achieve some goals of growing your income, but not just your income, but also your future wealth management. Now, one of the things I want to highlight in here is that there are two ways of investment. One is you go the passive investment and then the aggressive investment. And everybody will find a different way of doing it. And the reason is because you may be in certain point of your life. So if you're very early on your life, you probably see this very far away. You really worry about most likely sort of covering your expenses, trying to live day by day, and that's okay. And this is obviously the world that we live today is not easy. And then if you're in the middle age side, between 30 to 45, you start to sort of think about, well, I got maybe some additional cash. What do I do with it? And then you are somewhere reaching your maybe 50s, 60s, and you're thinking about, oh my God, I'm going to be retiring soon. How can I survive? How can I actually have the same level of life that I have today? So there are different reasons why people will want to invest. And invest is very different for everybody. And the reason is because everybody is unique. And of course, their circumstances are different. So therefore, there is not just one statement that fits all. But what's important, and that is what it means. Where are you today? And what you're trying to achieve. That's obviously what you need to think about it. I can give you here hours and hours on how to invest and what's the best ways. But I think what I want you to do from now on, as you see this presentation, is think about your current circumstances. So if you're on your early 30s, what do this mean for you? If you're on your mid 40s, is how can you maintain your wealth and grow? If you're on your late, probably 60s and 60s, there's how can I make sure that I can survive retirement because you don't have any more income? So with that in mind, I just want you to make sure that you understand that. One of the things that also is important is diversification. So when you invest, it's not just, oh my God, I have one investment and I'm done. I'm walking away. Well, no, you don't do that. You never put your eggs in one basket. So of course, you start with maybe one investment, and as that investment is secure or you are comfortable, then you maybe want to sort of invest in something else, especially it's in the market as you see today. It's cyclical. Therefore, there are times in the market that things would do well, like commodities, like gold, like properties, like shares, like bonds, currencies. So you really, if you put everything in one basket, or maybe depending on just one asset, you will end up obviously suffering when the cycle of that asset goes down. Therefore, one of my biggest sort of highlights on what is investing is all about diversifying your assets to make sure that you have enough diversification to secure your wealth, to protect it, to hedge it. So what I wanted to sort of emphasize is one of the questions which is quite interesting. It was, you can see the bubbles on the side in here. They were how exponentially increase my worth without much knowledge. Well, I have to sort of, be a bit realistic here. Is you can't really pretend to drive if you do not learn to drive. Full stop. And whoever thinks that they're going to be able to invest successfully by just grabbing some money and put it somewhere and forget about it and then hope for the best, in my opinion, that's gambling. That's not investing. Therefore, I suggest you take these 4 principles, right, into account, which is one of the biggest things that you need to do first is setting your goal of investment. You may have multiple goals. I don't know if you were able to see the video that Federica nicely edited with one of our media designers, but it says, one of the things it says, you need to set up your goal. And your goal could be multiple. You can have your goal to invest for retirement, to pay for your children's education, to travel around the world, to buy your first home. So you don't need just one goal to invest. But as long as you know why you investment, that will define your strategy. Also, once you do that, then you really need to understand what your risk tolerance is. Again, I keep going into these buckets of age, but it's important. Risk tolerance is, again, different for different people. So a risk tolerance, it means that if you're very young, you may be able to have a higher risk that gives you higher returns. Then you're in a position that if you lose a little bit, you still got time in your lifetime to recuperate. But if you are on the 60s up there, your risk tolerance should be very low, because it's all about maintaining the wealth and sustaining it. So you should really have a risk tolerance level. This is a should, you know, it's obviously, again, it all depends just personal circumstances. And if you invest in something and then you're in the late of your life, make sure that you can also afford to lose it. That's important if you are going to go high risk. And this is, I will talk about the risk tolerance later on a bit more. Choosing the right advisor and coach is important. Again, this will cover your knowledge. There is no one advisor that I have met that knows everything. And that is because advisors, and I will specify that later on, is they are financial advisors, they are independent financial advisors, and they are contracted financial advisors. Some of the financial advisors work for institutions. Therefore, they're only allowed to sell and advise on the product that they sell through the institution. They are independent financial advisors that they call themselves brokers sometimes, and these ones are also related, like probably maybe a broker to help you to get a mortgage, a broker to help you to buy gold. Those are independent financial advisors, but again, they do get a commission of what they're selling you. Therefore, you know, when you meet a financial advisor, you need to have the knowledge, you need to understand why you want to invest, and then go to the advisor and then decide what sort of product you're going to buy from them and why. That's the difference between a coach and an advisor. Coach guides you, give you the knowledge, the opportunity, helps you to set up a goal. The advisor executes that goal for you and give you the right product. And then I also, you know, this is obviously for a little bit more mature, but anything, even if you have one investment, don't just forget about it. Have a way of tracking the progress of that investment, because if it's a bad investment and it's not performing the way you should be performing, you need to move on. Don't leave it. Don't just, you know, if you buy a property and you think you're just going to leave it and hoping that the capital grows, and then you just keep making losses, you may want to sort of reconsider and resell it and restructure your capital to invest in something else. Therefore, it's important that you keep tracking your investments, not just leave them on the side, hoping that they will grow for you. So these are the 4 principles: the goals, risk tolerance, choosing the right advisors and coaches to guide you through the journey until you are comfortable enough, and then keep tracking your investments. And of course, I just got really 4 reasons why, you know, the benefits, and I think this is, you probably know this, but I just wanted to highlight, these are the generic ones, which is, of course, you want to grow your wealth. And wealth is not being multi-millionaire, is you got £100 right now, how can those £100 become 1,000 in a year? That's growing the wealth that you have. Today's 1,000, tomorrow it's 10. Therefore, that's what I'm actually looking at from that perspective. Also, prepare for retirement. I know I keep saying retirement, but whoever thinks these days that you are going to live from the money that the government gives you at the end of your retirement, if you live in the UK or in the US, it's very sad, in my opinion, because you will not be able to survive for what the government will give you. Therefore, it's important, especially for those on the early 30s, I urge them to really think about the future a little bit more, not so much panicking about it, but spending time of thinking, what would I need? How much do I need? And always think about the future to be able to prepare for it, because it comes anytime. When you turn around, is there. You think you're 30 forever. You don't. Children come, you get married, you get a lot of expenses, and then you realize you're like 55, 60, and you go, oh my God, what am I going to do? And you end up having to sell a lot of things to be able to survive. And also, economies change, right? So when you looking for retirement, look about big diversification again. I come from Venezuela, from a country that we were very rich. And I could have sort of sit back and say, oh, I'm going to live from whatever I get left over from my family when I retire. Well, unfortunately, the value of those assets is nil at the moment. Therefore, that would not be any good for me. Maybe for my children, the children of the children. But again, don't depend so much on things that that A, being inheritance, B, being just all accumulating to one part of the world in one sort of asset. I suggest you take more control and then really diversify a bit where you're going to invest for the future so that you can have a nice and comfortable life as you want to retire. Tax benefit, that is a key one. You know, why pay more money to the taxman when you can keep it to yourself? That's key. And I think it should resonate a lot to the young ones at the moment. You're working really hard, and then most of your pay goes to the taxman. So there are ways to make sure that that money doesn't go to the taxman. So I'm not going to tell you how. This is what you should be calling me. But in the end of the day, you can Google it. You can go there. You can go to financial institutions. There are loads of products out there and lots of ways, legal ways, to be able to save money, save it for the future without paying tax. And of course, compound interest, which is, mostly is the oldest one. When you save £100 every year, if you put into account to 3%, it's not £100 anymore, it's 103, and that interest compounds to the next year, and so forth and so forth. If you leave that for 20 years, you'd be surprised how much £100 is. You'll end up with probably 100,000. Therefore, compound interest, even if you leave it on your own, is still a good idea. So that's the benefits of actually start to think about investing. Now, I had other questions, which is, you can see them and read them in the screen. One of them was, if I have with a kind of investment, will I go with a budget of 40K, going for a safe risk, knowing that you already own a house or property? Okay, so you got 40K. I don't know who that, I can't remember who it was, but I'm not going to mention. So again, one of the principles I said before is, okay, if you got 40K is the only money that you got to invest, you're not going to put it all in one place, right? Because if you put it all in one place and something goes wrong, you lose your 40K. So my suggestion here is look at this slide and look at the amount of options that you have to invest. And this is equally important for everybody who has money to invest. Don't get attached to just one investment and hope that that's going to go well. I do believe that it's important that you understand there are lots of different channels for investment, avenues of investment, products to invest, but also then if you're not comfortable with those, then this is where you need to spend a little bit more time to educate yourself. So I'm going to go through them very high level. The stock market, I'm sure you all have heard of it, and I don't know how many of you own shares, right? So that's an interesting one. People think, owning shares, that's not for me. Well, there are easy ways to earn shares, very easy, through funds, through common funds, through actually your even banks. If you bank with NatWest, with Santander, with HSBC, with all of them, you can open an account today and then go, right, I want to open a savings account with a share trading facilities. And there is, you're done. Of course. And if you don't really want to sort of like be specific about the shares, then you go, well, I want a mix of, I want to follow the index 500. That's it. That's as simple as it. You get an index 500. It's always actually outside the market. That's it. £100 a month. That you are now investing in shares through an index. And the management fees through your account is very low. Now, if you've got lots of money, you may want to maybe talk to a financial advisor or to a fund manager, but they are expensive. And you really need to consider that what's if you've got 200,000, you want a fund manager, maybe it's worth it. But if you want to start to experiment with the stock market, an index 500, it always goes above the market, low risk. there are a lot of other ways to actually invest in the stock market. There is the spread betting as well, which is actually do not own the share, but you spread your cost through a bet on the share. And then, of course, the nice thing about this is if in the UK, I'm not sure that I haven't seen in another country like the US and Spain, that is free of tax because it's considered gambling. Therefore, your winnings are free of tax, which is quite attractive for some investments. So instead of buying the shares, you may want to bet on the share. You don't own the share, but you bet that it goes up or it goes down. Then you got, of course, cryptocurrency. I'm sure you all have heard of cryptocurrency. Some people go, oh, I will not touch it with a barge pole. I'm so scared of cryptocurrency. Yeah, it is. It is. The nice thing about the cryptocurrency, it is an alternative of the fiat money, which is a lot of it around these days. And they keep printing and printing and printing a lot. And just to give you sort of heads up, all the governments at the moment are going through cryptocurrency themselves. So, don't be surprised in the next 2 years, you'll hear that you have a dollar, currency, crypto dollar. You have the Bitcoin, and it will happen. It's coming. It's not if, it will come, and it's already in test. In the US, it was launched last year. In the UK, will be launched next year, and then with the aim to sort of formalize it by 2025. So read about it. I suggest you have a look at it because it's coming. Now, the difference between Bitcoin and then all these digital assets produced by the government is that these, of course, are decentralized Bitcoin and is not controlled by the government, where the central cryptocurrencies like Bitcoin will be obviously controlled by the government. So we will have no choice but use them if we want to trade. However, Bitcoin gives a very safe haven alternative. Therefore, I do believe that I will not buy all my savings and my investment capacity into cryptocurrencies, i.e. Bitcoin, but I will have some sort of maybe 5% of what I can afford maybe to lose, but also have a hedge contingency just in case. For mutual funds is very similar to what I was mentioning before, which is a diversify of funds. So you have a lot of different type of sectors in one fund. You have maybe pharma, you have real estate, you have technology, and it's like a mutual fund. And that's normally provided by the big financial institutions and the banks. So this is something that is very hard to go solo. You really need to sort of have a financial advisor to advise you and to give you that wrapper of mutual funds. Peer-to-peer lending is very high risk, high return. So peer-to-peer lending, there is a lot of websites out there in the market where you if you're willing to have £1,000 and you want to lend it to a startup or somebody, normally you get maybe 5%, 6% interest on that money. But again, it's high risk, and you could also lose it. Property, I think that's the oldest one of the things, and the loved one for most of people. I am very passionate about property. I got loads of properties myself, and so far they are long-term investment. They're not short-term investments. They are there for two reasons. One is for income, monthly income, and the other one is capital growth. And the nice thing about the property is that they are obviously sound. They do go up and down, but if you look at the graphs in any country, in any place, a part of obviously when the currency devalues, they do tend to keep the prices, even if it's in 10 for 15 years. They actually protect you with your current assets. They don't devalue in price. So if you have a property that was 100,000 a year ago, most likely has gone with inflation or more. So you can save your initial investment, plus, of course, protect yourself with inflation, and plus get some capital gains above that. The other thing about investment in property is that probably cyclical, every 5-10 years, when you have that capital gain, you have the opportunity to refinance your property, to pull more money out of that property so that you can buy more. And this is how the big portfolios are built. You use other people's money, not your own money. And then, of course, one of the key things about property is do not get emotionally attached to the property. It's an asset. So if it doesn't make you money, it's not a good investment. Oh, but I saw this beautiful apartment in the coast of Spain and it looks so beautiful. Does it make you money? No, then don't buy it. That's my advice. You need to, if you wash his face and it makes you money, it's a good investment. Commodities. Well, Federica knows I love gold. Part of wearing gold. I do believe this is a great opportunity for gold. And the reason it's a great opportunity for gold at the moment is because it's the way the market and the economy and the world is. There are three big key principles at the moment that gold is a good idea. The dollar is not losing, I'll say, that the standard of the current exchange, the standard one, but it's losing power on purchasing power. So we're no secret that Russia, China, Brazil are making trade in yuan. So I'm afraid that the dollar is going to get affected and it's going to definitely decrease in value. Equally with the euro, equally with the pound. Reason why is inflation is unstoppable. And as you can see it, you go to the supermarket, I don't need to tell you, you see as you're leaving, you don't need to read in the newspaper, you go out and you can see that things are costing more and you got less. So that should be enough for you to know that inflation is there. Nobody needs to tell you how much it is, what's the percentage. Your money that you currently have right now in a year's time will be valued less than it is today. Therefore, gold is a good hedging. And it's been actually 2 days ago, went over the $2,000 per ounce, which is unheard of. And the projections are higher than that by the end of the year. So if I was you and you have some money spare and you have in a savings account giving you 2%, you better off put that in gold for a while. My suggestion, I'm not advising you, but you choose. You have the money in a bank account, 2%, gold is a hedge and keeps through inflation. Bonds are loans, are OU. So you have government bonds and corporate bonds. Those are more complex. And again, you won't be able to buy those directly. You will obviously need to go through a broker. This is for more sophisticated investors, but they provide quite good returns, especially the government bonds. However, they won't be defaulting, but a country has defaulted in the past. So you again keep them with a pinch of salt if you are considering those. And certificates of deposits are long-term deposits that are certified by an institution, a bank or financial advisors or corporates or governments with a high yield of interest. But then again, you have to keep that money for a while and a fixed rate interest. And if you get out of that period, then you get a penalty. So if you are going to, for those ones, it's money that you just want to go, right, I don't know what to do with it. I can leave 300,000 in this corner, high yield, and in 3 years' time, I'll come back and see what I do. Yeah, good option. But again, all these products are different for all of you because you're in different situations. I just wanted to sort of give you a very high level view of all the type of opportunities that is out there and which ones you may want to invest depending on your current situation. Now, this is, again, now I have shown you all the type of investment. It's plenty more, but this was just a very high level. Of course, if we go into level detail, there are different type of shares, different type of bonds. We can be here for a long time, but that's not the point of the workshop. It was to show you your options. But then I want you to then look at what those options mean for your risk tolerance, but also for your time horizon. So time horizon is one of the things that you should consider in your goal. So I want to say, your goal is, I want to buy a property to invest. What's your time horizon for it? Well, today. Then I will ask you, do you have the money? No, I don't. Therefore, it cannot be today. So it's important when you set up your goals, you are sort of realistic with your horizon, right? And what is it that you need to do before? So now, if you have the money today, then buying a property, the time horizon of the returns of investment in a property is long-term, because it takes a lot of effort to buy a property. It's a lot of cost, initial, cost in the beginning, but then long-term, that property is going to give you a passive income, but also capital growth. Now, for short term, you're talking about maybe stocks. You buy a stock and for instance, that, I don't know, a company X who just launched an AI application and it's super popular, it's going up in price. Then your short term is to buy that share, hold it for X period of time, I know more than a year, sell it, you make your profit. That's the two different strategies, short term and long term. So you have to be realistic that some of the assets out there and some of the investment types are very suitable for short-term investment, and some of them are suitable for long-term investment. So the first thing you need to do before you actually is, again, assess the risk, which is actually important about when you're going to get into the market, right? If you say right now, I want to trade in dollars, I will say, well, have you looked at the dollar? Look at the volatility, look at that. So, there are lots of products out there, but they're not always the right momentum to invest on them. So you really need to find out the momentum of that investment. Also, before you invest, calculate the returns that you want to achieve with that investment. Don't just guess and hope. Right? So again, if you want to buy a property, how much do you want to make every month? That you should answer that question before you buy the property. How much do I want to make in 5 years' time of that capital growth? You should be able to educate yourself enough to be able to answer those questions, so then you are fully secure of the asset that you're buying. If you just going because, the market says so, or this is a very popular area, or somebody told me to buy this property because it's a good investment, I wouldn't. Would you just, jump into a void without even looking? No, you are going to put quite a lot of money into buying a property or buying an investment. You need to be fully comfortable that that's the right thing. So therefore, you really need to understand why you wait, what you're hoping for return on that investment. And again, as I say, understand diversification. Again, I think I have banged you on this one for a while now, a couple of slides. We'll keep banging on it, because I know some people feel comfortable with some products and some people feel more comfortable with others, and they will never want to go on some because they don't understand it. Well, you're scared because you don't understand. So, the first step is to understand it. It's no big deal. When you were young and you were about to jump in the car, your heart was racing and you didn't know what to do with the car. And then today, after 20 years driving, you can do with your eyes closed. Well, everything takes time. And I think I suggest if you're in this workshop and you're really interested, start to sort of explore all these products that I have actually put here in this slide, and trying to understand which ones do you think you can invest today as a short term, and which one do you think you want to do in long term, to diversify your portfolio so that you can then feel comfortable that you have wealth in the future, but also continuous income without having to work, which is that's one of the key elements. Make the money work for you, right? So again, short term, as I said before, commodity trading, gold, you can see gold, it goes in both. Gold, today, you can trade it as a short term for the next 6 months. But I have owned gold as a currency for a long time, and I leave it there. It goes up and down, but I know long-term gold never goes down. For me, it's a long-term strategy. It's liquid. I can cash it straight away with no penalty. And if a bank goes belly up, I still got my gold. I don't have to chase the bank for my money. So again, I'm sure that you're familiar with what happened to the banks. It won't be the first one, the SP, you got Credit Suisse. Quote me on it, few more will come, and they will go belly up. And if you're old enough to remember what happened in 2008, there were lots of banks, the rock How many people were, hitting on those doors, trying to get the money? You may get your money, not all of it, but it will take time for the government to get the money out of those banks and the debtors. So don't put all your eggs in one basket. Yeah, if you like the banks, then open more than one bank account. If you got more than £70,000 in one, 80,000 euros in the other. I think in the US is 210, but it's not always 210,000. It's depending on your investment and your abilities and your residency. Therefore, I will watch out if you got more than 250,000 in one bank in the US and you do not reside in the US. So I hope this slide gives you an idea about short term. I will put this on a PDF and Federica will be able to give you the link of where you can have a look later on if you want to have a look at it in a bit more detail. Now, somebody asked me, how to save and what to do with my savings. Well, probably some of you have heard this millions of times, but before I do that is pay debts or invest. Well, you need to pay your debts before you invest, because you invest with the money that you got left after you pay all your bills. And I will say this again, you pay your debts first, and then you invest with the money that you got left after you pay all your bills. Because you need to live. You really need to pay your mortgage or your rent, your food, whatever you need to, whatever your liabilities are. So pay your debts, because the debt interest is always going to be a bit higher than what you're going to get. At least you got something that is 0% interest for X period of time, and then you're confident that you can pay it off, then that's a different story. But rule of thumb is you really need to organize your debts, control them, get rid of them. There are good debts and bad debts. But if it's a bad debt, a credit card with a 25% or more, 40% interest rate, really trying to save the money to pay those first, right? Get that out of your sight. Now, saving to invest. Okay, well, I know maybe some of you have heard this before, but I don't think how many people do this. And if I go around the table, around the room now, I wonder how many people do have an automatic savings account. So what that means with that is, a part of setting up your goal, making a budget and start small, which is obviously the first 3 steps. It's even if you do that and you don't automate the saving, I can probably mostly guarantee that you will fail, because you will take a lot of effort from you to go every month, I'm going to put some money apart. I'm going to put some money apart. So if you earn 2,000 and you, I don't know, spend 1,500 and you got £500 left to leisure, to do whatever you want, but you own 2,000, my advice is trying to do 10% of your earnings, put it automatically into a savings account. 10. Be ambitious, 10. Once you have that discipline and that set of mind, 10 could become 15. And you can see that just by doing that, in a year's time, you see that money in there, plus the compound interest. It just becomes a first goal. It's a set of mind. It's a discipline. Saving is a discipline. You have to really put your set of mind and really be a little bit more responsible of reducing expenses that you don't really need. Some of us have millions of subscriptions. If you're really tight in money and you really want to save, there are a lot of things out there that you should not be spending on, like, I don't know, Netflix and Amazon and Spotify, and the amount of money that you spend could be £100 a month. If you look through your statements, I'm sure that £100 is in subscriptions and takeaways and Ubers and eats outs and things like that. Those are the things that for the young ones, I suggest maybe trying to discipline yourself and maybe put £50, even €50 a month. Do it now. As soon as you walk away from here, I got my son finally got a job, and then the first thing I say to him is, right, 10%. I sat down with him and I opened the account for him. And I know that he wouldn't even notice, because it's like a subscription. It's like a gym membership. So if we all spend time, paying gym memberships and subscriptions, I'm sure savings is easier to do that. So those are my advice for the people say, how do I start investment? Now, I have another slide about what type of investments, what type of savings. There are loads of them. And, you know, the more you look at, I have not even looked at Spain, I know that, but I'm giving you 4 of them. They are very, what I call generic across around the world, which is the basic one, which is the one I advise if you want to short term, you want to save to buy yourself a laptop, or saving, you know, just to accumulate some sort of short-term money to do something specific, then maybe an instant savings account is the right one for you. Then you got the high yield savings accounts, which is also called it in the UK regular savings account, which is it's a little bit high interest rate, but also requires a minimum balance and some sort of qualification. So that's a bit more. You may get, instead of maybe 2.5%, you may get 4%, but you have to put 20,000 in, and then you have to also earn X amount a month. You know, it has a lot of more, and then they have exactly the same in the US. You got the money market accounts, which is, these are actually offers a lot higher rates than the regular ones, but often require minimum balances. So you cannot go under a certain balance into your account. You cannot take it away. And you got the fixed rate savings accounts and certificate of deposit, which is, I'm sure some of you have done this. And I remember my parents going through this and then putting this money for like 5 or 6 years into this fixed account with a 3% interest. And then at the end of the day, with all the management fees that they have to pay, they got probably another 3,000 out of it. So fixed rate savings accounts are good. But again, it depends how much cash you're willing, you know, this is the cash that needs to stay put, right, somewhere, and you cannot take it out. And if you do need it for any emergency, you will pay a penalty. So going to these fixed rate savings accounts is good for people maturity, where they don't really need the money, where they are comfortable with keeping it cash, and they don't really need to make an additional, maybe they're happy to do a 5%. But that's all you're going to get for a fixed period of time. If the interest rates go up, you will not get more. But if the interest rates go down, then you still get your 5%. Okay, remember that you also, when you put this money in the long-term fixed term, you also have to calculate what they don't tell you is inflation. So, you know, is you get maybe 5% minus inflation. You need to be able to calculate this to see if it's a good option. And then I'm going to give you a little bit of the ones, my favorite ones in the UK. I always say to people, instead of doing a basic instant or high yield, the cash ISA is very good. The reason is because the cash ISA is actually tax-free. And if you put that money in that cash ISA, you do not get tax of the first 20,000. And then once it's in there, you can put it day one on the 4th of April, and then on the 30th of April, take it out and buy yourself whatever you want. So the beauty of the cash ISA is that, of course, if you are employee or self-employed, it's still a benefit to use it. So you'd be a fool not to use your allowance. If you earn more than 60,000 a year or more, you should be able to have a tax allowance of 20,000 a year. Because that money, once it's in there and it's been saved, then it can be used to do whatever you want after that. And invest it. And it's free of tax. You don't get tax on that 20,000. Notice savings accounts is, again, it's a long term, but you have to give 30 or 90 days provision that you're going to move the money away. So you don't get a penalty. So it's no instant cash. It's not like an ISA that you can tomorrow go, right, I'm going to take the money out. It's you have to sort of plan ahead and go, oh, all right, I'm going to need that money. So I need to notify the bank that I need to remove that money in 30 or 90 days. So they are a bit different, but they have obviously high interest rates. And children's savings accounts, I recommend that for anybody who has a newborn or about to or planning to, is paramount. In the UK, in the US, you have the college savings plan, which is similar. And you should do it. You should do it from day one. You should, the day baby's born, you start to put, I don't know, £100. And in the UK and in the US, when you open those, the government gives you incentive. They match it up the first time you open it up. Therefore, it should be really a nice lump sum for your kids to actually go to college without having to worry about paying for it, or actually for them having to get a loan to pay for an education. And again, for them, it's tax-free if it actually is used for education purposes. So it's a good start. And then in the US, you got the IRA, which is similar here to the SIP. I don't know, in the UK, SIP, in the US is the IRA, but it's for retirement. So the SIP is a self-investment plan, which is you can do it yourself. And then you open a specific account, you can put money in there for your pension, and you can only take it out on your pension age. And if you do it before, then of course you carry some tax. But again, you can control your own pension. You don't really have to, if you don't want to, give your money to Nest or to institutions to manage your own pension. You can do it yourself, equally to the IRA in the US. So these are sort of a couple of avenues to start to think about saving and what would be the best way for you to start to consider. Some of you maybe want maybe the 1 and 3, the 1 and 1, you know, the one on the top, which is a quick short ones. But the cash ISA, for those ones, for my followers in the UK, if you don't have one, you should have one now. It's the best one in my opinion. And for the children, one is called Junior ISA also. So the Junior ISAs are also similar to the cash ISA, but it's for obviously under 18. So how do I buy my first home? There is a lot of text in there. And now again, when you have time, you can review these. But I have here when to start looking into buy a home based on the current economy. Well, there again, your objective. I'm gonna, whoever asked me this question is, you buy a home because you want to buy a home, right? If you got the money, you buy it now. Now, if you wait for the right time, remember your home is not really ultimately an asset. It really becomes a little bit of a liability from a financial perspective. Why? Because you buy something, it costs you money, and every month you have to pay a mortgage. Therefore, it's taking money out of your account. It's not taking money into your account. So it's not an investment. It's really, you're buying it because you need a roof. However, long term, yeah, that house will gain some capital and some, you know, you're lucky enough in 10, 15 years time, you sell it and you make some money out of it free of tax because it's your residence. However, it should not be the drive of buying your home. You should be really looking at, you know, whatever money that you have, there will always be the right time to buy it. Of course, if it's very classical at the moment, the prices are collapsing, well, it's the right time to buy, to be honest. Why? Because it's a buyer's market. You do not buy when the properties are going up. So if anything, this is the right time to buy when the markets are collapsing. If you got the money and you got the savings, the time is to buy when things are hard for people, not when, you know, it's a buoyant market and you're going to pay double the price. So people tend to you know, be scared when the market goes down, but that's the right time to buy. Or properties are going to crash. No, they go down when the economy is shaking, but it's an adjustment. And then after the adjustment is finished, they go up that 20% and more in the next 5 years. And I'm not, don't quote me on it. Have a look at the graphs. In any graphs in the US, in Europe, all properties, you know, in the next 25 years have gone up. And they have been managed through inflation. So if it's your residence, definitely I'll suggest that you consider, especially in the next probably 6 or a year, 6 months or a year, because property prices are stagnated. They're not going to go up. If anything, some of them may go down, but at the end of the day, this is the right time to buy. This is the buyer's market. I know that you may face high interest on the mortgage, but that you can do the first mortgage fixed for 2 years to hedge yourself. And then once the interest rates start to go down again, you refinance with a lower interest rate. But it should not be the reason why you're not buying a property. So I gave you a couple of steps in here of things to consider. So this is only applicable if you're a first-time buyer. If this time you're going to buy, you think about how much you could save, and also you need to start to understand that although you got maybe 30,000, you are going to have some closing cost and some tax to pay when you buy a property. So don't think about that 30,000 is the money you got. You need to sort of take around, I always say, you know, maybe 10% of the cost away to pay for solicitor fees, for mortgage arrangements, and different type of expenses. Also need to consider that your income is going to take in account. So normally it's between 4 to 4.5%, 4 to 4.5 of your income. So that should give you an idea how much you got, what's your affordability criteria. Now, if you live in the UK, and also I know they have this in Spain, there is a lot of help to buy schemes for the government. Therefore, a normal mortgage, they will obviously give you sometimes 90% loan to value. A loan to value, what it means is the loan that is needed to buy the property. So if it's your first time, you can actually have a loan of 90% of the value of the property. But if you have a scheme from the government, you can go up to 5% extra, which is then is 95% loan to value. Therefore, you have more, obviously, money to put down towards your property. Therefore, the value of the property could go up. So, and I think in Spain, if I research well, is a plan de primera vivienda, which is also applicable. It's very similar. So you apply for that. Once you prove your savings and you have done your income, then you go online, you approve it, you get pre-approved. With that certificate, you go to your mortgage advisor and you go, I got pre-approved certificate, I got 95%. With that, then he just starts to run the numbers with his carriers, which is the lenders, and then he'll give you a list of options that you have to buy a property. With that, a pre-approval, then is when you're in a good position now to start to look for a property, right? And the reason I'm emphasizing on the steps is because when you buy in a buy-to-let, which is a property to invest, the order is a bit different, right? So I've got a question in here is, if I buy a flat with a 75% mortgage, does it make more sense to repay of an interest-only mortgage? Okay, so I think whoever asked me this question is, you need to understand that when you buy your residence, you pay capital plus interest on the loan. When you buy a property to invest, you want to minimize the amount you put down. So the only reason you're investing in that property is to pull money out of your rent every month and to have a capital growth at the end of 10 years investment. Therefore, I'm asking you, what would you pay additional capital when you don't need it? So it's a set of mind in here. People think about, oh, I have to pay on my property and then I will. No, but you end up having all your capital. Again, diversify. You will have all your money in one property instead of having the minimal that's required in that property. And then you have diversification in other assets. You can have more properties, commercials or residentials. You can have bonds. You can have shares. Therefore, I will never, ever advise, and whoever I'm sure financial advisors will give you exactly the same, is to pay capital on an investment property. You pay only the interest. That's the point. You pay the minimum amount that's required to pull the maximum for your benefit. That's why I wanted to emphasize what's residence and what's property. Now, before you even go to the broker, you really need to make sure that you research the location, the market trends before you go. Why? Because all this information, the brokers are going to ask you, and the lender is going to take this into account, right? When, if they don't look at you as your income, right? They look at the property. They say, I'm lending this money to this person to buy this investment. So they're looking at the property as the risk, not you, right? Therefore, you really need to make a research on the property. Is research on the property, you need to find out, is the criteria you're going to supply to right move in prime location and all of the beautiful portals that we have online, and then research how many properties in that area have been for sale, what are the prices in there. Now, when you find the more or less the prices in the area, you go, okay, now I'm going to go and do the same, but I'm going to search it like I was renting the property. And then you go, if I buy this 1-bedroom flat in Clapham, and then it's costing me 350,000, and I'm going to get a mortgage of, I don't know, £900 a month, interest only. Then you're going to Rightmove, you say, how much I can rent this property for? Oh, look, they are the same similar properties, they're renting it for 2,000. So that is the maximum that you're going to get out of property. And that due diligence, you need to do it because your underwriter, when he's looking at your loan application, is going to do exactly the same thing. And if you put 3,000 and the market says 2,000, he's going to go, nope. So, save yourself that time, and you do not want to be rejected by a lender. Right? Therefore, you really need to make sure that you research, and then you look at if the property washes its face. What I mean is it worth it? Don't, you're buying to make money and to make sure that you can make yourself 500, 600 pounds a month in your pocket, and then you can have a capital growth of maybe 50,000 in 10 years. If those two are not applicable, you don't invest. You move on to the next one until it washes its face. Do not try to manipulate the numbers. The numbers speak for themselves, and if it's not a good investment, then don't do it. So, and then once you have that criteria, then now you're ready to go to your broker and then get that pre-approved. Because when you're an investor, a property investment, if it's a good deal, it's probably like lots of people behind you who want the same property, or they are looking more or less at the same. So when you have a pre-approval mortgage, it's very, very easy to make an offer on the spot. You've done your research, you got the pre-approved, it makes money. When you look at the property, you put an offer subject to searches. That's it. So then you pull it out of the market, and then you take all your time in the world to do all your mortgage applications and everything. But if you have a pre-approved mortgage, it's very unlikely that it's not going to go through. So I hope that was you can see the difference between residential purchases and investment in property. There are two different approaches and two different reasons why would you buy a property. Now, somebody else, and is gold a solid investment? Well, yes, it is. Simple. And I'll give you all the reasons in there. I'll give you a little bit of course, of bullet points about what happened in the last 15 years and what happened after COVID, and how he said that it's going to 2000, it's gone down and up. But in short term, definitely. I myself, when I, in 2008, I knew that obviously the economy, like I do know today, it was a bit shaky. I remember buying gold at $400 the ounce, and I sold it for 1,000 18 months later. So, and it hasn't gone down to since then. So since then, as you can see in 2008 and now in 2023, it's doubled it up. So the gold that I have actually kept leftovers in that account, even though that I didn't sell it, it still has made money. So it's a solid, as I said before, it is a sound. I wouldn't put all my money in gold, but I will definitely give it a little bit of room in my portfolio. Definitely a 10 or 50% of my cash allocation always been to gold. And again, it's safe, it doesn't even give you an income. If you want an income, it doesn't give you an income. It's a hedge, it's a safety bet, and it's actually help you to maintain your value against inflation. How to invest? Well, you need to first, of course, educate yourself. There are so many ways to invest in gold. You can physically buy the gold and put it underneath your your bed or in your drawers or in your jewelry box, which is, yeah, we all have that. But however, there are more sophisticated ways to buy gold. Some of them, I think ETFs and mutual funds, if you do not want to own the gold. So let me just be clear about gold. So if you buy gold through a bullion vault, you have to, make sure that you have the money to keep it, but also you have some custodian cost. It's like, let me explain. It's like when you have a bank account, sometimes they charge you for the current account charges, service charges, fee charges. Well, those people who hold your gold in certificates, are involved in Zurich, in London, or in whatever part of the world, they will charge you on a monthly basis with a fee to hold the gold. So it's not enormous, but it is a fee. So you need to make sure that you understand that, but it's okay. I have that, and I prefer to buy my liquid gold. But I also have ETFs. ETFs are like funds. It's like a stock, right? So you actually buy ETF, which is a mutual fund on gold. So it's a group of, for instance, miners, right? So you don't buy the physical gold. You buy into the actually the structure of the gold on the market. Therefore, it's also a nice way to diversify your investment in gold. So the key takeaways, I know that nearly gone over 2 hours. I think we nearly sort of an hour, and so I just want to sort of again give you the points that I think should sum up the presentation. Is you need to obviously make sure that you diversify your investments and don't put everything in one place, and ensure you understand the risk between short-term and long-term. Stay informed. Again, remember in the beginning of the presentation, I say to keep track of your investments, but also it's not just keeping track isolated in one place. I'd suggest that you subscribe yourself to, I don't know, Yahoo Finance is very good. I love it. You go in, it tells you everything. I'll take a picture of what CNN tells me, and BBC tells me, and all of those. Go for really good investor utopia. There's loads of references sites out there. They are not linked to all the newspapers and the governments. They're very truly focusing on assets and investment, nothing to do with politics. Therefore, if you're really interested, I will sort of, go through those websites instead of taking too much of what CNN, BBC, TV, or all the news channels that we get bombarded with. And of course, again, don't, if you are, at the beginning of your road and initiative, really take advice, coach, read, educate yourself, buy books, talk to me, get your financial advisors, ask them questions. Why do I invest in this? I don't understand. They're there to explain to you. So don't take as a grace of what the financial advisor tells you. Ask them to explain, what happens if, or what do I do, what, and, it's your money. So you need to take care of your money. They get paid already, the commission. So really for them, whether you make money or not, it doesn't make any difference for them. They still get paid. So bear that in mind, please. And what I wanted to is, again, give you a little bit of a disclaimer in here. So I am not a financial advisor. I will never be a financial advisor. I have no interest to be a financial advisor. But I am passionate about coaching people to take responsibility and give them the knowledge that they need to succeed. Therefore, I just wanted to make sure that I'm here to actually helping you to develop, of course, your habits, your knowledge to achieve what you actually want to achieve from a financial goal. And sometimes all this is very interpersonal as well. Sometimes it's not just about money, it's about your family, your well-being, a balance, a balance about, work, a balance between, you don't want to work the rest of your life, or you don't want to work from 9 to 5, feeling like you're never going to have enough money. So it's a set of mind that I want to offer people, be able to understand that different ways to earn money, not just one way. And then provide a guidance when you need to, grab that phone, Carolina, what do I need, or how do I do this? And of course, what I need to actually, I will definitely give you the guidance, but also point you in the right direction to start to build your literacy and confidence on all these products, on what money is and what's not. The financial advisor is more specific to the advice that the service that they actually relate to. So, say before, you have lots of different type of advisors. Some of them independent, which is like they work like solicitors. They'll give you advice, you pay for the advice, and then they point you into the right direction. Some of them, they have to disclaim sometimes that they own they own a commission of the products that they sell. They have to disclaim that at all times. And then that they're good if you really instruct them what you want and how you want it. They don't expect them to tell you about your retirement. They just want to sell you products without having a context of what your life is all about and how it all sort of plans out. So I think if I have to choose one, I'll go mostly for the independent ones instead of walking into a bank and say to somebody, oh, give me some advice for what product should I buy. Go for independent ones because they have a wider view, a little bit of the world, and they may be sort of protecting a little bit more what your needs are. But they are also very good. They are more into the market. They know what products are there. So they are more, it's like a broker. I will never go and research myself what products for buy-to-let properties are. I have a broker that I work with, and I pay him every time that I buy a property for his advice. And then he gives me all, we spend probably an hour or two talking about the investment, and then I pay him for that advice, and then he goes away and then get me the loans. So there's value added to that. Imagine how much time or mistakes I will make if I actually trying to do by myself, trying to look on the internet. Doesn't work. Or go to a bank and ask for a loan directly to buy a property to invest. So there are good reasons why you should use one, and they're valuable. They also manage, some of them, the people who have, more than 100K to 100, 500, they have investment managers that they are part of financial institutions or investment institutions. So they manage a portfolio to the client. So they may have some bonds, some funds, and they manage and they provide maybe a quarterly report to the clients on the performance of those investments. So those ones are normally the advisory. They have a fee and also management fee. So the two fees: one, they advise you to reshuffle your portfolio, but also they will be actually charging you for the fees of buying the product. So what I'm saying is, you go, well, they look a bit similar. Yeah, they are if you actually want to do both. But as again, I do not advise you to buy specific a share or specific into a fund or specific into a property. I will never do that. I will help you together to make your own decision. And then what the time comes is, then I will point you to the right direction to maybe talk to financial advisors, accountant, tax advisors, then who can help you execute the solution. So that's what I want to make sure that you understood between the coach and a financial advisor. So my last one is, well, as a wrap up, is of course, we're here because we wanted to present of introducing ourselves, a new service, a new initiative, and also to give you the opportunity to, if you want to schedule first call, we have coaching programs. We will be continuing to do future workshops, but they will be maybe bespoke on this specific sort of investments and then how to do that. And those will, of course, will be payable workshops. I will continue to do maybe or in a quarterly basis free workshop, just to, you know, to bring some knowledge. It won't be so much educative, but maybe talking about the situation today, or what am I looking to do as an investment, just to share a little bit of my knowledge. So I wanted to continue to do that. We're planning to put newsletters, a lot more information in our social media. But again, they're there. These are the three services that we offering. So feel free to use them or pass them along to people that now that you heard of what we can do for you, you know, how can we focus an individual on starting to do some investment. If you think if anybody could benefit of it, just forward them maybe this video and also the website, so then they can have an initial conversation with us. Federica, I think we also decided that we were going to have a promotional first call
Yes,
pricing.
definitely. Yeah, well, to thank you everybody for being here present and to sticking in to Carolina's knowledge and sharing. We're gonna give away a promotional code of this 50% discount on the first call. So because our services work, first call to assess your case, depending on your goal that you want to achieve. We listen to you, we see where you're standing, and then Carolina draws a roadmap and provides a coaching program with one-on-one sessions. So you will enjoy a 50% off discount on this one. So I would really appreciate, since there are people that didn't sign up from the website, if you can type in your email so we can send the code that will be available for a limited time. So if you want to schedule your sessions with us, you can use it. And Caro, we also have one question for a friend, Tricia. And Guillermo, thank you for being here also.
Okay, so I got one question, which is I'll try to answer. I don't know you, but it's quite interesting. So for those who cannot see it, I'll try to read it. Which is the roadmap, for example, single person in the 30s who is employed, don't have a savings and want to have children in the future and create an investment for them. So you want a lot of things in here, which is good. So the roadmap. So roadmap, I think you need to sort of, although the future state, you don't really know what's coming. At least you know that you probably, if you are fully employed, which is it seems to be, my first advice is take advice of my slice of savings. That's the first thing you need to do. And in my opinion, I don't know where you live, if it's in the US or
it's in Venezuela.
In Venezuela, then you should really, my opinion is take as much as you can dollars, but also trying to diversify the currency somewhere else. If you can do euros and start to open an account outside Venezuela, not just in dollars, in another currency, buy some gold, just start to build your nest. This is the time for you to accumulate savings. Now, when you have enough savings, I don't know what your projection is in the future, is then you'll have the opportunity to have some down payment. So if you are buying the property in Venezuela, I suggest, I'm sure that there is actually schemes out there to buy, your first time. But if you're not planning to buy in the US, I suggest, because you don't reside in any of the countries, you take this as an investor. Right, so you can buy abroad as an investor, which takes less scrutiny than if you were buying as a residence. So I don't know your situation, what your future stay will be, but if you're 30s, the next 3 or 4 years should be building a capital, save. I gave you the steps. You need to make sure that you are due diligent every month. There are money market accounts that you can, as soon as you earn, you move the money somewhere automatically. They call it direct debit, standing orders. You can move that money into different currencies. I will never save the money all in dollars or all in one currency, especially not in bolivars. So that would be my first. And then think about what you want to be when you get married, and where would you want to live. And then start to maybe open an account in there, trying to build relationship in that country, So then you can start to build a financial background. I call it financial history. So when the moment comes, you're ready to buy a property. What you cannot do is buy a property with no financial history in the country. So if you want to buy in the US, the moment to buy to open the account is now. Start to save in that country, and then in less than a year, then you get a credit card, even if it's $2,000. You spend money on that credit card. You build your history, your rate, your credit score. So then when it comes to actually ask for a loan, you have a credit history. Equally in Spain, equally in the UK, whatever country you go, you still need to follow the same process. Hopefully that helps. So, is any other questions in there or no?
If you want to ask something, this is the moment.
This is the moment, so I'm not going to let you go. Some of you is early, some of you is late, but I do really appreciate your time that you have spent listening to me. I hope it was being useful.
Yes, we're very happy. We're very happy with the attendance and the interest on the project. Also, as a reminder, if you want to receive the promotional code, please type your email here if you didn't sign up from the website. And yes, I really, even myself, I enjoyed the information with Caro. And yeah, thank you all for being here.
Thank you very much. Have a nice evening. Hope to see you soon all.
Bye.